There's a moment in every market cycle when the noise stops being noise, when the signals everyone dismissed as temporary suddenly line up in a pattern that demands attention. We're in one of those moments right now. China, the world's second largest economy and a critical driver of global capital flows, has entered an 8-day pause. Markets are closed, liquidity has frozen, and while most analysts are calling this routine, something different is happening beneath the surface. Capital isn't waiting for the doors to reopen. It's leaving, not slowly, not cautiously, fast. If you hold assets tied to Chinese markets, if you're invested in emerging market funds, if you have exposure to commodities that depend on Chinese demand, or if you've been considering whether now is the time to enter these positions, this video is for you. I'm not here to tell you the sky is falling. I'm not here to sell you fear. I'm here because I've studied market cycles for over 2 decades, and what we're witnessing right now isn't random. It's the convergence of debt pressure, currency instability, policy exhaustion, and capital flight patterns that historically signal the beginning of a longer correction, not the end of a temporary dip. This isn't about making predictions. It's about understanding probability. It's about recognizing when the conditions that once supported an asset class have fundamentally shifted. And it's about knowing what disciplined investors do when the crowd is still debating whether anything has changed at all. Let's talk about what's really happening. First, let's establish the facts without the spin. China's markets have closed for an 8-day holiday. This is not unprecedented. Lunar New Year closures happen every year, but what matters isn't the closure itself. It's what's happening during the closure and what preceded it. In the weeks leading up to this pause, we saw significant capital outflows from Chinese equity markets, Chinese bonds, and yuan-denominated assets. Not retail panic selling, institutional repositioning, the kind of moves that don't make headlines but show up in custody data, foreign exchange reserves, and cross-border settlement reports. When major capital moves this way, it's not reacting to a headline. It's responding to underlying conditions that have reached an inflection point. Let's understand what those conditions are. China's property sector, which represents roughly 30% of the country's GDP, remains deeply distressed. Despite multiple government interventions, bailout packages, and liquidity injections, default risks remain elevated. Major developers continue to struggle with debt obligations. This isn't a 2-month story anymore. We're 3 years into a structural unwinding that hasn't resolved. At the same time, China's local government debt levels have reached historic highs. Provinces and municipalities that borrowed heavily to fund infrastructure during previous stimulus cycles are now facing repayment pressures, while tax revenues decline. This creates a negative feedback loop where the entities that would normally absorb fiscal stimulus are themselves in need of support. Add to this the ongoing demographic shift. China's working-age population has been declining since 2015. This isn't a projection. It's a present reality that affects consumption, productivity, and the sustainability of debt-driven growth models. When your workforce shrinks, your ability to service existing debt through future growth diminishes. Now layer in the external pressure. Western companies have spent the past 3 years quietly diversifying supply chains away from China. Not completely, but meaningfully. Manufacturing that once seemed permanently anchored in Chinese provinces is being replicated in Vietnam, India, Mexico, and other emerging markets. The shift reduces foreign direct investment inflows and weakens long-term growth assumptions. Finally, and perhaps most importantly, we're seeing currency pressure. The yuan has been under persistent weakness despite central bank intervention. When a currency weakens while authorities actively try to support it, that tells you something about underlying capital flows. People aren't just selling Chinese assets. They're moving the proceeds out of the currency itself. This combination, property distress, local government debt, demographic decline, supply chain diversification, and currency pressure, creates a macro environment where traditional policy tools lose effectiveness. You can cut interest rates, but if businesses and consumers are deleveraging, credit doesn't expand. You can inject liquidity, but if capital wants to leave, it finds a way. That's what has changed, not one headline. A convergence of structural pressures that have moved from theoretical concerns to active constraints. Here's what most market participants get wrong about situations like this. They look at headlines and assume each event is isolated. Property sector problems are a property story. Local government debt is a fiscal story. Currency weakness is a monetary story. They don't see how these pieces connect. But experienced analysts understand that modern financial systems are interconnected feedback loops. When property developers can't meet obligations, it affects local governments who depend on land sales for revenue. When local governments face budget pressure, it affects their ability to support banks that lent to those developers. When banks face pressure, they restrict credit, which slows economic activity, which reduces tax revenue, which creates more fiscal pressure. This is how localized problems become systemic ones, not overnight, gradually, then suddenly. Another common misunderstanding is the belief that government intervention can indefinitely postpone market corrections. China has enormous state capacity. They can mobilize resources, coordinate policy, and direct capital in ways that Western democracies cannot. This has led many investors to assume that Chinese authorities will simply manage any problem that emerges. But there's a difference between managing a problem and solving it. Managing buys time. Solving requires either inflating away the debt, growing out of it, or defaulting on it. Inflation destroys savings and triggers capital flight. Growth requires productivity gains that are harder to achieve with a shrinking workforce and maturing economy. Default triggers financial contagion. None of these paths are painless. What we're seeing now is the exhaustion phase of the management strategy. Authorities have been managing these interconnected problems for years. They've been extraordinarily successful at maintaining stability far longer than most Western analysts expected. But management has a shelf life, especially when underlying fundamentals continue deteriorating. People also misunderstand what capital flight actually looks like. They imagine panicked crowds rushing to withdraw money. In reality, institutional capital flight is orderly, quiet, and persistent. A pension fund doesn't dramatically exit a market. It simply reduces allocation percentages during quarterly rebalancing. A sovereign wealth fund doesn't announce it's leaving. It just lets positions mature without renewal. A multinational doesn't shutter operations. It builds redundant capacity elsewhere and gradually shifts volume. This kind of capital movement doesn't create headlines. It creates trends that only become obvious in retrospect. By the time the trend is clear enough for casual observers to notice, the move is largely complete. There's also a psychological trap that catches even sophisticated investors. It's called recency bias. For the past 15 years, every significant dip in Chinese markets has been followed by recovery. Investors who bought those dips were rewarded. This creates a Pavlovian response. When prices drop, buy. When fear emerges, fade it. When others panic, get greedy. But market history shows us that patterns that work for years can fail decisively when underlying conditions change. Japan in 1990 looked like a temporary correction to investors who had been conditioned by 4 decades of growth. The pattern that always worked stopped working because the fundamentals had shifted. The same thing happened with U.S. housing in 2006, with European sovereign debt in 2010, with commodity supercycles in 2014. The challenge isn't identifying that something has changed. The challenge is accepting it when all your recent experience suggests the old pattern will reassert itself. This is why most people misunderstand moments like this. They're looking at what worked recently, not what works when fundamentals shift. They're seeing individual headlines, not systemic patterns. They're trusting government intervention to work forever, not recognizing when intervention has exhausted its effectiveness. Understanding this distinction is what separates investors who preserve capital during inflection points from those who learn expensive lessons. Let's talk about what history teaches us about moments like this, not to predict the future, but to understand how markets behave when certain conditions converge. Every major market correction of the past 50 years was preceded by a period where warning signs accumulated, while prices remained relatively stable. This creates what's called a divergence between fundamentals and valuations. The underlying reality deteriorates, while market prices reflect optimism, inertia, or the momentum of prior trends. Eventually, something triggers a repricing. Often, it's not even a major event. It's a minor catalyst that simply breaks the inertia and allows price to realign with reality. The Asian financial crisis of 1997 started with Thai baht devaluation, a seemingly isolated event in a small economy. But it exposed over-leveraged positions, triggered capital flight across the region, and revealed that what looked like stable growth was built on unsustainable debt. The pattern repeats because human psychology repeats. When asset prices rise steadily, investors justify valuations with optimistic narratives. When problems emerge, they assume authorities will intervene successfully because they have before. When small corrections happen, they're viewed as buying opportunities because recent history validates that behavior. Then something breaks. Not the biggest problem, necessarily, just something that shifts market psychology from problems will be managed to maybe they won't. Once that shift happens, capital that was patient becomes urgent. Investors who were waiting for clarity suddenly prioritize certainty over returns. The same positions that everyone held comfortably become positions everyone wants to reduce simultaneously. This creates a liquidity crisis, not because assets are worthless, but because everyone wants to sell at the same time and no one wants to be the buyer until prices fall significantly. The fall itself then triggers more selling. Margin calls force liquidation. Risk management systems automatically reduce exposure. Institutional mandates require cutting positions that have dropped below threshold levels. None of this requires fundamental catastrophe. It just requires a shift in market psychology from complacency to concern. That shift can happen slowly, then very fast. Now, let's apply this to China specifically. Over the past decade, China has been the beneficiary of enormous capital inflows. Foreign investors wanted exposure to the world's fastest growing major economy. Index inclusion meant passive funds had to allocate to Chinese equities. Belt and Road Initiative projects channeled capital outward, then back through investment returns. This created a self-reinforcing cycle. Capital inflows supported asset prices. Rising asset prices validated the investment thesis. Strong performance attracted more capital. The cycle continued as long as growth remained robust, policy remained supportive, and global liquidity remained abundant. But each of those conditions has changed. Growth has slowed from double digits to low single digits, with significant debate about whether official statistics even capture true conditions. Policy has become less effective as traditional tools like interest rate cuts and fiscal spending face diminishing returns. Global liquidity has tightened as central banks worldwide have withdrawn pandemic-era stimulus and raised rates. When the conditions that created a positive feedback loop reverse, you get a negative feedback loop. Capital outflows put pressure on asset prices. Declining prices validate concerns that prompted outflows. Poor performance triggers more selling. The cycle works in reverse. History shows us that these reversals tend to last longer than anyone initially expects. After Japan's market peaked in 1989, it took 3 decades for valuations to approach those levels again. After the dot-com bubble burst in 2000, it took 7 years for U.S. tech indices to recover. After the 2008 financial crisis, some markets took 5 years to regain previous highs. I'm not suggesting China faces a 3-decade bear market. I'm illustrating that when fundamental conditions shift, the correction phase can extend far longer than recent experience would suggest. Markets don't typically bottom when problems are most obvious. They bottom when conditions have improved enough that forward-looking investors see reasonable risk-reward in deploying capital again. That process takes time. It requires either fundamental improvement, valuation reset, or both. Right now, we're in the early phase where problems are becoming undeniable, but most investors still expect relatively quick resolution. History suggests we're likely in the first inning of a longer repricing process, not the 9th. This doesn't mean every position in Chinese markets will collapse. It means that the probability distribution has shifted. The risks that seemed remote now deserve serious consideration. The recovery patterns that worked for 15 years may not work this cycle. And the assumption that buying dips will be rewarded requires more scrutiny. If you currently hold assets with significant Chinese exposure, whether direct equity positions, emerging market funds, commodity investments, or international allocations, let's talk about what this moment means for you specifically. First, understand your actual exposure. Many investors hold Chinese risk without realizing it. An emerging markets ETF might have 30 to 40% China weight. A global equity fund includes Chinese companies. Commodity positions depend on Chinese demand. Mining stocks reflect Chinese consumption patterns. Technology companies derive revenue from Chinese markets. Your exposure may be larger and more interconnected than you think. Take the time to map your actual China exposure across your portfolio. Not to panic, but to understand what you own and why you own it. This is basic risk management that should happen regularly, not just during stressful moments. Second, revisit your investment thesis. Why did you establish these positions originally? Was it for growth exposure, diversification, momentum, index inclusion? Some investors bought Chinese assets because the fundamental story was compelling. Others bought because prices were rising, and they didn't want to miss out. The reason matters now. If your thesis was built on assumptions about continued high growth, policy effectiveness, and capital inflows, those assumptions need reassessment. If your thesis was about diversification, you need to evaluate whether Chinese markets still provide true diversification or have become correlated with global risk assets. If your thesis was technical or momentum-based, you need to recognize that momentum works until it doesn't. This isn't about selling everything in panic. It's about honestly evaluating whether the reasons you bought still apply, given changed conditions. Third, consider your time horizon and liquidity needs. If you're holding these positions in a retirement account with a 20-year horizon, your response should differ from someone who needs liquidity in the next 12 to 24 months. Long-term investors can afford to ride through volatility if they maintain conviction in eventual recovery. Near-term capital needs require more defensive positioning. But be honest about whether you can actually stomach significant drawdowns. It's easy to claim long-term patience when portfolios are stable. It's much harder when positions are down 20, 30, or 40%, and headlines suggest more downside ahead. Know yourself. Paper losses become real when they force behavior changes like selling at the bottom or abandoning a sound strategy. Fourth, think about position sizing relative to your overall wealth. A 5% allocation that drops by 30% is a manageable loss. A 40% allocation that drops by 30% is a significant wealth impairment. Concentration creates both upside potential and downside risk. During uncertain periods, concentration risk deserves special attention. If your China exposure is larger than you'd be comfortable losing, that's important information. You don't have to exit entirely, but you might consider reducing to a size that allows you to hold through volatility without emotional decision making. Fifth, avoid the trap of averaging down automatically. Many investors have been trained to buy dips. When positions fall, they add at lower prices to reduce cost basis. This works beautifully in corrections that quickly reverse. It's catastrophic in protracted bear markets where cheap becomes cheaper and then much cheaper. There's a difference between buying dips in a bull market and catching falling knives in a structural downturn. The discipline that served you well in one environment can destroy capital in another. Before adding to losing positions, ask whether you're responding to opportunity or reacting to loss aversion. For current holders, this moment is about honest assessment, risk calibration, and emotional preparation. It's not about knowing what will happen next. It's about being positioned in a way that allows you to respond rationally regardless of what happens next. You can maintain positions. You can reduce them. You can hedge them. You can hold and do nothing. What you cannot do is ignore that conditions have changed and pretend your positions exist in the same environment they did 2 years ago. If you don't currently hold significant Chinese exposure, you might be wondering whether this represents a buying opportunity. Let's talk about how to think about that question properly. The media and social media investing spaces will show you two narratives. One side will say everything is falling apart and you'd be crazy to invest. The other will say blood in the streets is when you buy, and this is the opportunity of a decade. Both narratives are overly simplistic. The reality is more nuanced. Chinese markets have declined significantly from previous highs. On a valuation basis, many assets are cheaper than they've been in years. If you believe in mean reversion and long-term growth, current prices might look attractive. But valuation alone is not an investment thesis. Markets can remain cheap for extended periods when fundamental conditions are deteriorating. Japanese markets traded at low valuations for decades. European banks have traded below book value for 15 years. Russian markets offered compelling valuations before geopolitical risk materialized into actual losses. Cheap can get cheaper, especially when the problems causing the cheapness persist or worsen. So how should you think about potential entry into Chinese markets or assets dependent on Chinese growth? First, acknowledge that you're considering entering positions precisely when uncertainty is elevated. That's not wrong. Some of the best long-term returns come from deploying capital when others are fearful. But it requires extreme discipline, long time horizons, and the ability to endure further downside without panic. If you're considering entry because you have genuine conviction about long-term fundamentals and you're prepared to hold through potentially years of volatility, that's different from trying to catch a quick bounce. Know which investor you are before committing capital. Second, understand that catching exact bottoms is impossible and unnecessary. Trying to time the perfect entry point is a fool's errand. If you believe in the long-term value proposition, it's better to enter gradually over time than to wait for perfect clarity that never comes. But gradually over time means months or quarters, not days or weeks. It means building positions as conditions evolve, not going all in at the first sign of stabilization. Third, size positions appropriately for the risk. Emerging market investments, particularly in economies facing structural challenges, deserve smaller allocation sizes than core holdings. A 3 to 5% allocation that performs poorly is disappointing. A 20% allocation that performs poorly is wealth destroying. Right size the position for the actual risk profile. Fourth, separate conviction from hope. Conviction is based on thorough research, understanding of risk factors, and clear-eyed assessment of probability distributions. Hope is wanting something to work out because you bought it. Before establishing positions, write down your thesis, your risk parameters, and your exit conditions. This prevents emotional attachment and provides a framework for evaluating whether your thesis remains valid. Fifth, consider alternative ways to express similar themes. If you believe in Asian growth but are concerned about China specifically, look at Vietnam, India, Indonesia, or Taiwan. If you want emerging market exposure but worry about geopolitical concentration risk, look at Latin America or Eastern Europe. If you want commodity exposure but are uncertain about Chinese demand, look at assets driven by decarbonization or infrastructure spending in developed markets. There are usually multiple ways to express an investment thesis. In uncertain environments, choosing expressions with lower geopolitical risk or better fundamental clarity can provide similar upside potential with reduced downside risk. For those not currently invested, the key message is this: absence of position is itself a position. Not being invested in something that declines preserves capital. Not being invested in something that rises is opportunity cost. Both matter. But in environments of elevated uncertainty, capital preservation should take precedence over fear of missing out. If you eventually want Chinese exposure and believe in long-term value, you'll have opportunities to build positions over time. Markets don't go from troubled to perfect overnight. There will be time to participate if and when conditions improve. Rushing in now because prices have fallen is not a strategy. It's a reaction. Strategy requires patience, discipline, and honest assessment of risk-reward dynamics. Let's talk explicitly about behaviors that destroy capital during periods of market stress. This is as important as knowing what to do. First, don't make major portfolio decisions based on social media posts or headlines. The information environment during market volatility is designed to trigger emotional responses. Fear gets clicks, outrage gets engagement, complexity gets ignored in favor of simple narratives. If you're making significant capital allocation decisions based on what you read in a tweet or saw in a sensational YouTube thumbnail, you're responding to manipulation, not information. Seek out primary sources, read actual financial reports, review custody data and capital flow statistics, understand policy documents and official statements, form opinions based on evidence, not on someone else's interpretation of that evidence designed to generate views. Second, don't confuse volatility with opportunity automatically. Yes, significant investors have made fortunes buying when others panic. But for every Warren Buffett buying during the financial crisis, there were thousands of investors who bought falling knives and suffered severe losses. The difference isn't courage, it's capital reserves, time horizon, analytical capability, and emotional discipline that most individual investors don't possess. Volatility creates opportunity only if you have a genuine edge in analysis, if you can stomach further drawdowns, and if your time horizon extends beyond the panic. If you're reacting to price movements rather than responding to fundamental changes, you're speculating, not investing. Third, don't use leverage during uncertain periods. This might be the most important warning in this entire video. Leverage amplifies returns in rising markets and amplifies losses in falling ones. When markets are volatile and trends are unclear, leverage transforms manageable losses into catastrophic ones. I've seen sophisticated investors destroyed by leverage during market dislocations, not because they were wrong about fundamentals, but because leverage forced liquidation at exactly the wrong time. Their thesis eventually proved correct, but they were no longer in the position to benefit. Leverage eliminates flexibility and patience, two critical advantages during uncertainty. Fourth, don't abandon a sound long-term strategy because of short-term noise. If you have an appropriately diversified portfolio built for long-term wealth accumulation, temporary volatility in one component shouldn't trigger wholesale changes. Review your allocation, adjust if your circumstances or risk tolerance have changed, but don't mistake market volatility for a reason to abandon disciplined strategy. Markets reward patience and consistency over time. They punish reactive behavior and constant portfolio churning. The cost of being wrong about market timing is typically higher than the cost of maintaining reasonable long-term positioning through volatility. Fifth, don't ignore the situation entirely. The opposite of panic isn't indifference. Some investors pride themselves on never looking at portfolios during downturns. That's not discipline. That's avoidance. You should be monitoring positions, evaluating whether your thesis remains intact, and ensuring your risk exposure remains appropriate for your circumstances. Ignoring problems doesn't make them disappear. It just ensures you'll be unprepared if conditions deteriorate further or if opportunities emerge. Sixth, don't assume this is like every previous dip. Recency bias is dangerous precisely because it works until it doesn't. The correction that looks like every other correction until it doesn't is how the most damage occurs. Treat each market environment as unique, requiring fresh analysis, even if it ultimately concludes that your prior positioning remains appropriate. Finally, don't lose sight of what matters. Your investment portfolio exists to support your life goals, not the other way around. If market volatility is causing severe anxiety, lost sleep, or relationship stress, your positioning is wrong regardless of whether it eventually profits. Wealth that comes at the cost of well-being isn't wealth. It's a prison. Right-size your risk exposure to your actual psychological capacity, not to what you think you should be able to tolerate. There's no shame in being more conservative. There's significant shame in losing sleep over positions that were too large for your emotional constitution. We've covered a lot of ground. Let's bring this together. China's 8-day market pause is occurring against a backdrop of significant structural challenges. Property sector distress, local government debt, demographic decline, supply chain diversification, and currency pressure have converged to create conditions where traditional policy tools are less effective than they've been in decades. Major capital is leaving not because of panic, but because institutional investors are responding to changed fundamental conditions. This isn't retail fear. It's sophisticated money repositioning based on deteriorating risk-reward dynamics. History teaches us that these kinds of inflection points tend to last longer than initial expectations. Markets don't bottom when problems are most obvious. They bottom when conditions have improved enough or valuations have reset enough that forward-looking capital sees opportunity. For those currently invested, this is a moment for honest assessment. Review your exposure, Revisit your thesis, consider your time horizon, evaluate your position sizing, and avoid the trap of automatically adding to losing positions. You don't need to panic, but you do need to be realistic about changed conditions. For those not currently invested, understand that cheap can get cheaper and that waiting for greater clarity is not the same as missing opportunity. If you eventually want exposure, build positions gradually over time with appropriate sizing for the actual risk involved. Above all, avoid emotional decision-making, leverage, herd behavior, and the assumption that recent patterns will continue indefinitely. Markets reward discipline, patience, and emotional control. They punish reactivity, overconfidence, and denial. None of this is about predicting what happens next week or next month. It's about understanding the conditions we're operating in and positioning accordingly. It's about recognizing when probability distributions have shifted and adjusting risk exposure to reflect that shift. The investors who preserve and grow wealth through market cycles aren't those who perfectly time every turn. They're those who maintain appropriate risk exposure, who avoid catastrophic mistakes, who think in probabilities rather than certainties, and who remain flexible enough to adapt as conditions evolve. You don't need to know exactly what happens next. You need to be positioned such that you can respond rationally regardless of what happens next. That's the difference between surviving market cycles and learning expensive lessons. This situation in China matters not because it's unprecedented, but because it represents the kind of inflection point where disciplined thinking separates itself from reactive behavior, where patient capital distinguishes itself from hot money, where real analysis matters more than popular narratives. Stay informed, stay disciplined, stay honest with yourself about your actual risk tolerance and time horizon. Understand that market cycles are inevitable, that corrections are healthy, and that the best opportunities often come from situations that everyone else wants to avoid. But also understand that opportunity without preparation is just gambling, that conviction without capital preservation is recklessness, that long-term thinking requires surviving the short term. The crisis, if we want to call it that, isn't happening to you. It's happening in markets. Your job isn't to predict how it unfolds, or your job is to be positioned appropriately for a range of outcomes and to maintain the emotional discipline to execute your strategy regardless of noise. Markets will continue functioning. Global trade will continue. China will still be a major economy next year and in a decade. But the path from here to there matters greatly for capital preservation and growth. Navigate it with clarity, not emotion. With discipline, not reaction. With patience, not urgency. That's how wealth is preserved through uncertainty. That's how opportunities are captured when they genuinely emerge. That's how you separate yourself from the crowd that reacts to every headline and the crowd that ignores everything until it's too late. You're equipped now with framework and context. What you do with it is up to you. Choose wisely, act deliberately, think probabilistically, and remember that in investing, as in life, how you respond to uncertainty matters more than predicting it correctly. Thank you for watching. Stay sharp.